I do want to bring in our markets guest to talk more about this action. Ted Oakley, he's a managing partner and founder of Oxbow Advisors, joins us now. It's good to have you with us this afternoon, Ted. Quite the day on Wall Street. A lot of volatility still in this market. What do you make of the action?
Well, Kristen, we made a shift maybe 2 weeks ago, and the momentum stocks all of a sudden started getting pressure. And that's what's really been happening. If you look at the primary momentum stocks, and a lot of the momentum stocks that weren't making any money, they were trading on losses as far as operating income, and those have been correcting quite a bit. And I think that's what's happening. But the second thing happening is when you start to see this movement of rates, all of a sudden the mortgage rates move up over 3. People look at that because housing's been a big driver, of this whole thing, and that could really cause some problems.
So it's interesting. I'm looking at the Nasdaq, Alphabet, Google, that company actually one of the biggest gainers, but generally we see losses pretty broad-based. Intel, Home Depot, Walt Disney, the biggest losers on the Dow. So again, sort of broad-based losses across the board here, Ted. The funny thing is that rising interest rates signal an improving economy, yet it has investors worried and investors selling their stocks. Why is that? How long does that last?
Kristen, what happens with inflation is I think people are playing off a reflation thought process where if you reflate, things are good because things are getting better, people are coming out, et cetera, et cetera. However, if it's inflation, where prices of goods are starting to go up, and if you look at all commodities are up, average gasoline price is up 55 cents a gallon just in the last 2 months. See, that's a different kind of thing, and inflation is not good. Inflation gets into the profit margins, and that is why people need to make that distinction. I think they're trying to verbalize the reflation, but in reality, it's the inflation that really causes the problem.
Interesting, though, Fed Chair Jerome Powell saying that the Fed is not going to move on its ultra-low interest rates on the Fed funds rate as short-term borrowing costs until it does see the economy return to full employment. So unemployment of about 5% or so, even though many estimates say it might be until at least 2024 that this economy does fully recover all of those jobs lost, the 22 million jobs lost in both April and March, and then consistent, not just full employment, but inflation at that 2% target. Up until this point, the Fed hasn't seemed too concerned, and even the comments that we got from Fed Chair Jerome Powell, Ted, they don't seem to be too concerned. So do you think that the market is overreacting to this?
Kristen, I do not. First of all, I don't usually take what the Fed says what it really front-end cost and what they're saying, because I don't really. I've found that over the years, you're better just to think on your own because the Fed can change on you. And believe me, Powell would change too. If you let the market correct, to a deeper level, that's what they played off of now since he came into office. So I don't think that's as much as anything. The problem you have with the Fed right now is the bond market can overrun them, which is what's happening right now. They're going to be in a bit of a pickle here. If you get the 2-year or the 10-year up to say 2% or higher, 2.25, and they can control that 0 to 3 year, but they can't control that 10 to 30 year. And then all of a sudden they have to make a decision which way we're going to go here. And I think that's what they'll get into. I don't think they see it. I don't think they're aware of it. And I think that's where the trouble will come in probably third or fourth quarter.
So as we see heavy selling, Ted, my question is, again, how long do you think it will last? And are there places where you see opportunity in this market?
There is, Kristen. We have a number of things that we don't, a lot of the growth stocks we're not buying. They're just not back in a zone where we would buy them. But we have large holdings in energy, and we would add energy if you didn't have it. If you look at pharmaceuticals, they're really cheap. That's something you could add. We see a lot of consumer type stocks that are really cheap. Good dividends, the good things in that area. I know everybody's gone toward, they look at where can I enter, say, tech stocks or semis or that sort of thing. And actually, a number of the semiconductors are probably getting in a zone right here to where you might take a look at those as well. But we continue to keep quite a bit of cash around, and we just pick things off one at a time. But those are some areas we really like right now.
Interesting. Semiconductors, obviously a very key part of the Nasdaq and the tech-heavy index. But again, to your point there, Ted, we do see some of these momentum plays unwinding. Tesla is a perfect example. That stock well below its $900 all-time high. We also see the Nasdaq closing 10% below its record high. That does technically mean the Nasdaq is now in correction territory. And the Nasdaq today even turning negative for the year in 2021 year to date. So some of these gains that we saw earlier on, especially in January and early February, now coming home to roost just a little bit. We're awaiting earnings from companies like Slack, Gap, among others, Costco as well. Ted, any of these companies that you're watching after hours that you might be considering investing in?
You know, Kristen, we don't buy companies that are losing money, and really, Gap hasn't turned positive yet. I think they will, but they're not yet. Slack's the same way. So that's not the type of company we would own. And we really, I think Costco, you know, it's been under more pressure than Home Depot, and that's not a stock we own either. We do own the convertible preferred in Broadcom. They're coming out after the close too. I think those numbers will be okay, but we don't own the common there either. We own the convertible preferred, and it's done really well for us. But we really, when you get into sell-offs, these companies that don't make money, and there's a lot of them now, they tend to have trouble. I mean, I looked last night, for example, at the new lows for the year, the New York Stock Exchange, and it looked to me as though 85 or 90% of those were SPACs. So you can sort of see what comes under pressure when the market, falls apart.
Ted, we've been talking about energy for weeks now on the show, for months actually, that it's been a potential winner here in the market. We certainly saw that when that horrible weather swept through Texas and other parts of this country, the extremely cold weather that also led to blackouts. How long does the energy trade last? At what point do you maybe take some profits in the energy space?
Kristen, I think it's early in the game. You have to realize nobody's drilled anything for almost 2 years now. I'm talking, if you were looking, at the peak, we were producing 13.5 million barrels a day. We're producing about 9 million now. And it's not like you can turn the spigot on. I mean, you have to go out and develop that and bring that on. It takes a long time. And people are probably thinking, well, $65 a barrel. It would not surprise us at all sometime in the next 18 to 24 months to get $100 oil. And primarily on supply demand, you have to think about it. We really haven't brought jet fuel back on or a gasoline back on is where it should be. It's coming back, don't get me wrong, but there's a lot of upside left, and we think in the oil, and that's why we like that space a lot, and natural gas for that matter.
Ted, we got to leave it there. Thanks so much for joining us today. That's Ted Oakley, managing partner and founder of Oxbow Advisors.